You are listening to Keystone's Stock Talk Show, episode 307. This week, I will kick off our Your Stock Our Take segment, answering a viewer and client question on search and AI giant Alphabet Inc., symbol GOOG or GOOGL on the NASDAQ, amidst reports indicating Apple has open talks to use Google's Gemini model to power a revamped Siri. Continuing in this segment, Brett answers a viewer question on Neptune Digital Assets Corp, symbol NDA on the TSX Venture, which operates in the crypto and blockchain space. The stock has had a very volatile last year. I'm interested to get Brett's take on what is driving the roller coaster in this stock. Brennan handles our star of the week, that is AEHR Test Systems, AEHR, in the NASDAQ, which provides equipment for testing chips, not of the potato variety, much to Brennan's disappointment. We have followed the company for a while and saw the stock surge 40% today on positive announcement, which Brennan will detail. And last but not least, Aaron will give his take on story stocks, or speculative narrative-driven investing in 2025 and the risks ahead. He will talk about the recent rise in interest around speculative, non-profitable stocks and the associated risk. Could we be talking meme stocks again? We may be. All right, let's get to the show. I'm going to welcome my co-hosts, Mr. Aaron Dunn, the Killer Bees, Brett and Brennan. How are you guys doing?
Gentlemen, doing well.
Good, yes.
The summer is almost over. It's crazy.
Yeah. Yes. One of the signs of summer ending around here is my daughter usually does a lemonade stand with herself or a couple of her friends, and we did that over this weekend. We used to have this lemonade where you'd put out like a jug on a table, maybe on a table or in your hand, and that was it. No, they make it into a whole thing where they're offering like lemonade, ice cream, cookies, like 2 different flavors of lemonade. They have just different packs, right?
Freshly
like family
squeezed,
pack.
right?
Oh
right
yeah,
in front of you, made right in front of you.
Mint from the garden, all of this. So it was pretty amazing. But they don't do it for an hour. Like we were there from like 9 a.m. in the morning till 7 a.m. or 7 p.m. at night. So they go hard at it, and they did well. But it was pretty cool. So I said I would give a shout out to my daughter Eden, her friend Akam, and Izzy. There we go on the podcast. But they said I had to do this because we were sitting there. They were servicing a client at the lemonade stand, and I had said a few things, and a guy said, "Aren't you Ryan?" And I'm like, "Oh," he's like, "Yeah, I heard you on Money Talks. I listened to your podcast." So they said we had to say shout out to Steve.
I love it.
A listener. And they
Thanks
said,
for listening,
but anyways, Steve, I think he's from
Ryan
White Rock.
Irvine is finally famous.
That's
everybody.
The girls were looking at me like totally different after. Oh my God, I'm like, no, that is not.
It's just
true,
locally.
But, oh, it's hilarious. It was pretty funny. They stuck in it to the end. And if you're gonna do that, it's a great teaching moment. Like just talking about handling cash and customer service, and they were out there like flyering the neighborhood and going door to door and stuff. It's pretty cool.
Well, it's funny that you bring up the lemonade stand, because I didn't do a lemonade stand this weekend, but my daughters were asking me more about what I do for a living. And I used a lemonade stand as the analogy for somebody building a business and then needing capital to expand, and, somebody like me to analyze the business and make a recommendation on it. So interacting with the lemonade stand was useful in both scenarios.
Yeah, it almost killed me this weekend. About 12 hours of lemonade stand.
It's a long time.
Probably a lot of money from the sounds of it.
It's time, and they have
Oh no, you don't make money. You spend money. No, I'm gonna make probably made a lot of money. It's easy when it's 100% profit, right?
Well, we're buying lunch. We're buying. It's like
they're like business. Inventory. It's easy.
This is so easy.
Money and it's yours.
Yeah, it's good. It was good.
Free lunches.
They had a great time, and I think they're
and
donating some.
Which
they had the college fund tip there. They're 10 years old and had the college fund tip, and then they had. They're also gonna go shopping for part of it. It's like 33% here, 33% there, and spreading it out. So you got to have a little bit of fun. So they'll have a good time. All right. Well, anything else we want to talk about that has anything to do with stocks, the markets, anything like that? You got nothing. You got nothing.
I'm on lemonade stands now.
Yeah, that's more. Well, we can get right into. I mean, we do have a live 10x webinar coming up this week on Thursday. What is that? The 28th, 7 p.m. Is that correct? Yep. Pacific time.
Correct.
Yeah, 10 a.m. Eastern. The tickets are going extremely well for that. So if you want to grab a ticket, you can go to our website, www.keystocks.com. There'll be 6 stocks we'll detail there as potential 10x long-term stocks. We'll go over some case studies about in the past, some stocks that actually not only have done 10x, but 100 and 200x. We'll detail the Hammond Powers of the world that literally have gone 200x since our original recommendation, and get to the commonalities of why you want to look at these type of stocks, the profile of what you want to look into. And again, giving those 6 stocks with that 10x potential. So if you aren't a client, we encourage you to attend that. If you're an existing client, you got access to that about a day after the event. So no need to purchase that. So today I thought I would give a brief overview on Alphabet. Share rose this Monday about 2% in the morning, extending about a 3% rally on Friday after reports Apple has opened up talks to use Google's Gemini models to power a revamped Siri. Bloomberg reported Apple asked Google about building a custom Gemini model that could replace parts of Siri as soon as next year. Market reaction reflected the potential commercial tie-up between the two. I have to tell you, just this is anecdotal. Obviously, the last several times I asked Siri something, the answers were not so good. So I would say Siri does definitely need an upgrade. And Gemini does sit near the top of the benchmark list for language and multimodal tasks, while Alphabet has moved kind of cautiously on its AI strategy. The talks come as regulators examine Google search deals with device makers. A U.S. court may rule soon on remedies that could affect search placement agreements. It's interesting times for both companies. So I thought we'd look through our current coverage on Alphabet, just generally at present. Again, Alphabet should need no introduction. It's a holding company, holding Google, the internet media giant. As a wholly owned subsidiary, Google generates 99% of Alphabet's revenue, of which about 85% is from online ads, search, YouTube ads, and Google networks. The fast-growing Google Cloud now accounts for about 14.1% of revenues. The company is considered an AI leader. So let's look at the recent quarterly financials here. We can look at Q2 2025 total revenues. Alphabet reported relatively strong revenue growth. Total consolidated revenues $96.4 billion. That's up 14%. Earnings, the company's net income was $28.2 billion, 19% increase year over year. Diluted EPS grew faster, 22%, up to $2.31. That surpassed analyst estimates. Operating income also saw a solid increase, up 14%. Cash flow and capital expenditures, we'll talk about this a little more in a minute. This quarter was marked by significant increases in CapEx expenditures, which rose 70% year over year to $22.45 billion to fund aggressive AI and cloud infrastructure investments. As a result, quarterly free cash flow saw a 61% decline to $5.3 billion. However, trailing 12 months cash flow remained at $66.7 billion. So some of the positives on the investment thesis here: continued strength in search. One of the worries with the boom in AI is Google search, but search delivered double-digit revenue growth in the quarter. AI Overviews now has over 1 billion monthly users, and AI Mode, the new end-to-end AI search experience, has over 1 million monthly active users in the US and India. While Google's search market share is decreasing slightly, it still holds roughly 90% of the market. We can see here, if you go back to July 2025, 89.6. This is just the latest figure. And then if we look at January, if you go back to January, it's about 89.7%. So a slight downtick there. And the year over year, it is down from 90.8. So Google search and other properties revenue accounts for, again, 57% of Alphabet's total revenue. It's a very important part of the business, something that we monitor closely. Google Cloud, the rapid expansion and profitability here. Their cloud was a standout performer with revenue surging 32% year over year to $13.6 billion. The segment operating income more than doubled, increasing to $2.8 billion and significantly expanding its operating margin from 11.3% to 20.7%. Let's look at further positives here. AI's impact on the business. We talked about this. Their CEO talked about this in the quarter. It's positively impacting every part of the business, driving strong momentum. New features like AI overflows and AI mode in search are performing well, and more than 85,000 enterprises are now using Gemini, driving 35 times growth in usage year over year. There's good momentum in YouTube and subscriptions, which showed strong performance. YouTube Shorts revenue per watch hour in the US now earns as much as traditional in-stream ads, and in some countries it even exceeds that rate. So areas to watch here for Google, certainly. Significant increase in capital expenditures. We talked about this. They're increasing their expenditures, their CapEx expenditures for 2025 to approximately $85 million. That is up from the previous forecasts of around $75 billion. Aggressive investment, again, is to support AI development and cloud infrastructure. We talked about this. Significant increase in free cash flow. Still generating strong free cash flow, however, over the past trailing 12 months. But again, this continued investment is to remain a leader in AI. It's likely a smart decision and comes from cash on hand, not debt with no dilution. That is important to remember. Overall, the company continues to add cash. The regulatory environment is a concern here. Alphabet faces a complex and escalating regulatory environment, particularly with ongoing antitrust lawsuits in both the US and Europe, targeting its dominance in search and advertising. In the near term, this could lead to significant fines and court-mandated changes to its business practices, such as being forced to divest parts of its ad tech business or alter its contracts with device manufacturers. In the near term, this could be a negative. In the long term, there are some arguments to be made a major unfavorable ruling could potentially lead to a forced breakup of the company, which would fundamentally restructure its business model and operation strategy. Again, in the immediate term, the reaction of a forced breakup would likely be negative due to the uncertainty. There's long-term thoughts, though, that many analysts are now leaning towards the possibility of positive outcome. Maybe it's because they own the stock, but I mean, there is some history of this in the past too. That would potentially unlock significant value in its high growth segments of the business. Potentially that could outweigh the loss of synergies, especially if the new independent companies become more focused and agile. Some analysts point to the breakup of AT&T, where the baby bells, or companies that were forced to split from AT&T, actually outperformed the market for years, even decades after. However, the final outcome would heavily depend on the specific terms of the breakup and the ability of each new company to thrive on its own. So in conclusion here, Alphabet is a high-quality tech giant, leadership in AI, strong number 3 position in the cloud, and resilient search business with reasonable valuations relative to its peers. We can look at the valuations here on a forward PE basis. Now, how does that compare to the historic 5-year valuations on the stock? About average right now in terms of PE and price to cash flow. It was significantly below just 3 months ago, as we can see right here. That was a time where we're aggressively telling clients to buy. So fair value, likely in the range of 224. It's starting to approach that, slightly under right now. That would be a multiple of around 21 times a 2026 estimate. Okay, and that closes off. But interesting news certainly today. I mean, it's not been confirmed, but interesting news from Bloomberg that there could be a partnership for a revamped Siri. It's Siri. Siri isn't that what's his name? His kid. Tom Cruise's kid. All right, doesn't matter.
I have no idea.
I honestly have no idea either.
I know, but yeah.
On the topic of
interesting news.
of
Siri.
Google. I mean, well, on the topic of Apple, since you brought up Siri, yeah, you're right. Siri needs a huge revamp. It's really falling behind, and Apple has taken heat for really falling behind. It's not even in the discussion right now in terms of the AI race. The discussion is really Microsoft, Alphabet, Amazon, and Meta. Those are the four big players, right? So Apple's got to get in. But yeah, I mean, with Alphabet, you're looking at a company which is certainly one of the leaders in the AI space. Double-digit growth, cash flow, reasonable, like great valuation. I mean, if notwithstanding the regulatory risks, you have this huge regulatory overhang, which is real, and it's more than what you would normally expect of the Mag 7, which is where there's always a lot of regulatory risk. So it's real regulatory risk, but obviously a lot of it is factored into the price, because if you didn't have that, you would not have a company trading like with Alphabet's fundamentals trading at sub 20 times earnings.
Yep. Excellent. Any further on that, or?
I was just going to say, like, I remember this was probably, or this was
because you did
like,
some work, Brennan, on the regulatory
exactly. I was just going to say, like, for people to take a look at our blog, where I did, look at essentially just like the antitrust cases, both against their search and search advertising side of the business. Again, I think I'd be a little bit worried about the search advertising than the search side. Again, when I first started doing, the due diligence, I didn't even understand or didn't even know that it was, two different cases really here. But one thing that I did want to mention is just, I remember, back in late 2022, we had, Google as one of our recommendations, I believe, in one of our DIY webinars. And we ended up getting an individual reaching out to us who had attended that webinar, basically saying, that, we're, how the heck could we be recommending Google? It is, horrible business, and this was down when, it was trading at about $100 per share. I wish I could find that email of this individual, saying this. I lost it somewhere. But, like, just look at what the stock has done. It's up over 100%. Just looking at, an individual that was seeing the stock price go down, over 2022 when there was this tech sell-off essentially, and they were emotionally like, wow, the stock price is going down, bad recommendation. Meanwhile, we're telling our clients, okay, the valuation's getting attractive here again. We should probably be positioning ourselves longer term. And again, this is a business that, we're not looking to hold for just 1 year. We're looking, 5-10 years out. That's just really kind of what I wanted to add as well.
Yeah, for sure. I mean, and good quality businesses, when they come on sale, that's when we like to add, for sure. Mm-hmm. Yeah. Good. All right, let us move on. I think we're continuing in our Your Stock, Our Take segment. Brett's going to answer a question on Neptune Digital Assets, a company that I believe he looked at about a year ago, in that range, or over the past year.
It was last November when I looked at it.
Yeah, in the last year.
I've looked at a couple of these crypto holding companies, the other one on the podcast being MicroStrategy. I can't remember if we did any of the other ones, because that's something that's been the really flavor of the month or flavor of the year, is these cryptocurrency holding companies for Bitcoin and now Ethereum and so on, and some other ones.
Yes.
Here, before you start too, Brett, can you guys hear that background noise, or could you hear that tractor outside? No. Okay, perfect. Good.
Tractor. Only.
Well, it's a Zoom boom. It's not a tractor. It's a Zoom boom.
It's still funny.
Yeah. So, like Ryan said, covered the Neptune Digital Assets last November. And it subsequently, it surged in price, but it's since declined. So we can look at it as a bit of a dog of the week, a bit of an update in general, however we want to slice it. So Neptune Digital Assets, symbol NDA on the TSX Venture. If you don't know, it operates in the cryptocurrency and blockchain space. Neptune engages in operations across the digital asset ecosystem, including Bitcoin mining, proof of stake for various chains, blockchain nodes, decentralized finance or DeFi, and other associated cutting-edge technologies. The company, however, is just in its current form is effectively reliant on its various crypto assets holdings to drive value. So, like I said before, the stocks have really just had a turbulent time over the past year since really becoming that focus on a crypto treasury company. The shares are now trading at $1.08, a $137 million market cap. The stock is still significantly higher than what it was a year ago before the shift, up 300%. But that is about 61% lower than the all-time high of 278 set in late January of 2025. And since the prior segment I did last November, the stock is up 10% from 98 cents. So a bit more of a dog recently, with the last month it's actually fallen about 21%. So bit of a dog, bit of a your stock our take, but let's go through the company. So first off, we're just going to look through the income statement. It's not really the driving force or value creator for the company, apparent, because it's not really an operating company, but it helps explain the business. So that's why I want to go through it. As you can see, though, the revenue from Bitcoin mining and staking crypto is all of its revenue, and it's not much. If you net off the costs of mining against the mining revenue, it's effectively break even, and that's before depreciation, which would probably put it slightly into a loss position. And then with about $200K in revenue in staking revenue in the last quarter, this will vary heavily quarter to quarter, just depending on the stake crypto asset prices, just the way it's marked. And the staking revenue does not really cover the costs of other expenses, consulting, SG&A, etc. So you're an operating loss company. It's a holding company. It's similar to other traditional financial holding companies in any sense. The other line items, which I just want to highlight here as well, that are notable are the revaluation in realized and unrealized equity security, which leads up to the net loss of $737K. But those revaluations are due to the equity holdings, mainly SpaceX, as well as they do have an equity fund, which is about $1.2 million at this time, but non-substantial now. With the cryptocurrency revaluations as well, and that is below net income, it's not added to your EPS, so it's comprehensive earnings. Due to the accounting standards, that added about $7.9 million to the comprehensive income. So it's really just the crypto value is driving the company. So shifting to what the company holds, is that it is really, at the end of the day, the most important aspect of the company. It is dominated by Bitcoin at this point in time. I know the company initially was, we're a Solana holding company, really wanted to drive up that aspect, but it was still, even at that time, it was still driven by Bitcoin, and it is even more so now. They hold 405 Bitcoin at a current market cap, or current market value of $45.6 million, and that represents 82.3% of the crypto assets. So it's just dominated by Bitcoin, with the second largest crypto holding being Solana at 12.6%, or just under $7 million, with the remainder being an assortment of Atom, Sonic, which was formerly Phantom, Ethereum, and others, including Elon Musk's favorite Doge. The other notable investment, and perhaps probably the most interesting in my opinion, is the company actually has a private equity stake in SpaceX, which was last valued at $8.2 million for their stake, and that'd be on a $400 billion market cap. So massive market cap, but they don't hold much of it. And that's actually, we had a question last time, which I wanted to highlight, that they were asking something along the lines of, is it a suitable way to gain exposure to SpaceX through NDA? And the reality is no, it's not what drives the market value. It's too small of a stake, even in respect to the company's market cap, is not going to be what drives the value of the shares, at least under their current degree of ownership. The other fact to consider with the company, it is leveraged, although not a significant degree at this time. They have about $6.4 million in outstanding debt, which is about 10% of their total financial assets, and that's borrowed at 8.9%. and is secured against the 102 of the company's Bitcoin at the time. That value may fluctuate over time depending on the price of Bitcoin and how much they borrow. But something which I see brought up time and time again for the support, the bullish thesis behind these Bitcoin treasury companies or crypto treasury companies in general, is these institutions are able to borrow and leverage at a lower rate. And that's not really occurring, at least with NDA here. I know, MicroStrategy, you can argue that to a higher degree, but you're not seeing that here. 8.9%, that's not unreasonable for a retail investor to get a margin loan at, or even some other sort of leverage term loan or personal finance loan. Under the current facility, though, they have borrowing capacity of $25 million, so they could leverage up a bit more if they desire to. But overall, when you do compare the total investments against the market cap of the company at this time, the shares have a 68% premium, so you're overpaying. If you're looking at a traditional holding company, normally they hover actually slightly below the book value of their assets. And right now there's a 68% premium. So you're overpaying in respect to the underlying assets. And further, that might even be hindered even more, as there is $12.7 million in outstanding stock options and warrants, which, if exercised, would actually keep the premium about the same right now, just the way the math happened to work out, it would be about still 68%. But depending on which ones are exercised, so if those lower, the 20 and 30 cents ones are exercised, that premium would go up. If they're all exercised, it will say just happens to be about the same. But you do lose that long-term upside. And if you were ever wanting to buy something like this, you'd be looking towards the long outstretched upside. And those warrants do start to hinder that, especially if they do become every year they dilute another 10 million options or 10 million shares through options. That does add up over time. And that is something you don't watch ever if you were to invest in anything ever like this. Is dilution does matter over time. And for comparison's sakes, as the company is primarily holding Bitcoin and it is a driver of the stock, it is really the driver of the stock more than anything. Let's compare the price. Since my segment last year, relatively arbitrary date. And as you can see, Neptune did outperform Bitcoin for most of the time since, but Bitcoin actually ended up just, once again, arbitrary date. It's actually had a high return over the past 9 or so months, 27% compared to about the 10%. Relatively arbitrary date, but you can also see here, which I really want to point out, is how volatile Neptune is. And this is because you have speculative assets, crypto speculative, whether you're completely bullish or not, it is a very speculative asset just by the stats behind it. And then on top of that, you have it wrapped in a speculative financial structure, being the holding company, as it does not intrinsically need to attach to that net asset value all the time. So you have 2 layers of volatility, so you just get these massive, massive swings. If you ask me at the start of the year, the stock would have been a star of the week instead of a dog of the week. But right now, you can see the last month, it is well underperformed Bitcoin. And now it's our dog of the week more than anything. So really, just to sum it up, very speculative stock. The share value is disconnected from net asset values like most crypto treasury companies. And for now, it is our dog of the week.
Yeah, I mean, I guess when you said at the end there, underperforming Bitcoin, yeah, it seems kind of pointless because there seems like a higher level of risk and underperforming right now, in the last month. Yeah,
absolutely. Like, it is a bit of an arbitrary data, and I know people will argue about that if you bought here at this point in the graph. But the reality is if you bought during those times when it was $2, $2.50, you would have lost money. And that's at the end of the day that's what I was trying to warn out against about my segment last year. These do get very hypey stocks. They can go way up, but they'll come right back down eventually once the fundamentals do eventually start to matter. It may take some time, but it does have that gravity against you. You're pushing up against it. So it's not a great business model at the end of the day. None of these really are. They might make you money in the short term for traders or speculators, but a long-term buy and hold investor, they just aren't suitable in any manner. If you want Bitcoin, buy Bitcoin. Like, it's just that simple.
Yeah, I think keep it simple, stupid on that.
Exactly.
Is what we would recommend. All right, Brennan, unless you guys had anything further on that. Brennan, hopefully you don't get run over by a tractor. There was something happen out there, right?
There's some construction in the background.
Yeah, we're
hopefully
good.
You guys can't hear it.
We can't hear it. Don't worry. You're going to talk about our star of the week, AEHR Test Systems. Had a pretty sizable announcement today, at least sizable in terms of what it did to the market cap. It was up about 35-40% today.
So yeah, thanks, Ryan. Let's jump into AEHR Test Systems here. So this is our star of the week, a company which we have followed for the past few years, which is up over 40% today after a positive announcement. So the company trades under the ticker symbol AEHR on the NASDAQ, currently trading at a price of about $25 per share, market cap of about $530 million. They don't pay a dividend. And they are a provider of test solutions for testing, burning in, and stabilizing semiconductor devices in wafer level singulated die and packaged part form. And essentially, AEHR's products or its systems increase the quality, reliability, safety, and security needs of semiconductors used across multiple applications. So we actually wrote a monitor report on the company in June of 2025 at a price of $11 per share. And I wrote in that report that the business possesses several positive attributes, but that it remains higher risk given the macro headwinds and that it is a contract-driven business. But we continue to monitor the company closely today. Looking at the share price, the stock is actually up 150% over the past 6 months and is up, like I said, 40% today. So let's dig into why the stock is up so substantially today in the trading session. Well, what's driving it is they announced that a major hyperscaler expanded its AI processor production capacity with additional air test package level and burn-in systems, which is for 6 Sonoma ultra high power package part burn-in systems for AI burn-in testing. But they did not disclose how much the additional follow-on orders would be for or who it was specifically for. But they did indicate that they would be delivered in the next 2 quarters, Q1 and Q2 of 2026. So the stock was up significantly following this announcement. Now, looking at the financials, we can see that margins have been contracting through fiscal year of 2025, given a decline or a slight decline in revenue, and adjusted net income was actually negative in Q4 of 2025. That is for the period ended May 31st of 2025, all while the business has temporarily withdrawn guidance given these macro uncertainties. But they did announce that they expect growth in fiscal year 2026, but they do remain cautious. And as you can see here from the valuations, they remain very pricey at this point from a trailing standpoint, as it's at trading at over 160 times trailing earnings, excluding cash. They do have a net cash position on the balance sheet, and over 400 times trailing EBITDA. So very expensive, in my opinion, at this point. So to conclude here, the acquisition of Inkle Technology, which I didn't really talk about today, but I did highlight it in that monitor report for clients, which was made in August of 2024, does allow AIR to offer a line of high power packaged part reliability burn-in test solutions for artificial intelligence or AI semiconductor manufacturers. And the announcement today that it received additional follow-on orders for 6 Sonoma ultra high-powered package part burn-in systems for its lead production artificial intelligence processor customer for part burn-in is positive. And this has led the stock significantly higher, making it our star of the week. But at this point, my question is, how much does it really move the needle of the financials? As you know, we kind of remain in the dark on this front of how significant this announcement really is. Now, the balance sheet remains healthy with net cash per share of 46 cents. Although they do continue to issue shares. This is something that I highlighted in the report. They have an at the market program. So if someone's interested in the stock, that is something to keep an eye on, is that they don't dilute too much. And again, that net cash position on the balance sheet is more from, issuing shares than just generating cash flow. Right now, I do believe that the trailing valuations remain extremely pricey. Fiscal year 2025 wasn't the best given macro uncertainty and contracting margins, and management has yet to reinstate guidance for fiscal year of 2026. To me, the stock remains more speculative right now. It's high risk for high potential reward. It's really going to be interesting to see how much these recent orders move the needle, or if the news release today has led the stock to jump way ahead of its underlying fundamentals. If all of a sudden we don't see anything drastic in the fundamentals over the next, few quarters, I could see the stock coming back down as quickly as it increased today. So, I would say it's tough to say right now, but regardless, the stock will likely be highly volatile and will be a name we continue to monitor, and it is our star of the week.
Yeah, it's certainly interesting company we monitor. As I understand, AIR generates kind of one-time revenues off the sale of their Fox, XP,
Correct.
and Sonoma products. So again, like you said, this makes sales lumpy since they are unpredictable, depend on customer production ramps and a number of things. Things look solid right now. We just, when we have these contract driven businesses, we either need the backlog to continue to go higher and know the margin on it. And if we don't have that, and on top of that, we don't pay a massive premium for companies like that, because if the backlog turns south, you can really take a hit. So I think they are trying to add some recurring revenues, this business as well. But again, we monitor it. It's good to see the jump if anybody owns it today, but we probably wanted it at a lower valuation to take some of the risk out. Okay, we're going to move to our final segment, right? We've gone through 3. That's how it
Correct.
works. And we're going to our final segment. And that's Aaron. He's going to look at kind of story stocks. Is it the rise of meme stocks again?
Well, it's the possible resurgence of meme
Okay.
stocks.
We're on the
It's certainly a
cusp,
speculative wave
potentially.
and a trajectory towards that.
Yeah.
Why don't I?
And does it hint towards a bubble or a high market valuation? I mean, that's what you could look at.
Oh yeah.
Risk comes down, and you go down market, and if you're starting to see a return to meme stocks or story stocks, it can be a negative for the overall market, mid to long term.
Well, I would say definitely. I would say definitely.
Yeah.
Yeah. Great. So let's take a look at that. So what we're looking at right now is what some would refer to as a speculative wave in the stock market that has really started to occur, I would say, probably since the market bottomed around April of this year. So the what we're really looking at is what we would call story stocks. But the story of this segment is really how the speculative investing is impacting the markets in 2025. And then also some of the risks associated with that refocusing of investor attention into high risk, low quality securities. So first of all, what is a story stock? Well, I would say that a story stock, for anybody who understands Keystone's research and how we go about doing research, which is focusing on finding strong underlying businesses that are producing real profitability by selling products and services, I would say a story stock is the opposite of that. A story stock has a great story to tell in terms of being in an exciting industry or having some form of an exciting technology or something that you can look forward to in the future, but really not so much to report in terms of current progress, at least not in the form of cash flow and profitability and revenues, which is what you would expect from a business. So it's really common to see these types of companies in certain industries like technology with AI right now. Clearly, many of the AI stocks are making great money, but there are a lot of smaller companies or mid-sized companies or even larger companies that are really just trying to ride that wave. But also in other areas as well, crypto, Bitcoin. And what is really fueling this is investor enthusiasm. Once investors get excited, they think they can make some easy money. Things just kind of spiral from there. So what is going on right now? So as I said, there has been recently a lot of enthusiasm that has gone back into the more speculative part of the market. So just if you want to take a snapshot here with a couple stats to give you an example of what this looks like, 45 out of the top 50 companies on the Russell 3000, the top 50 year-to-date gainers had at least one quarter of quarterly loss in the past fiscal year. Most of them were not profitable at all. Now, there's a couple companies in there where you could say, well, maybe that's just seasonality. But in the vast majority of cases, it's not seasonality. These are just companies that aren't making money. So 45 out of the top 50 were not profitable. On average, unprofitable stocks on the Russell gained about 36% since the bottom in April of 2025. And you compare that to about 16% for the profitable companies on the exchange. So there's obviously a disparity here, a focus on companies where the story is incredibly attractive, but where the underlying fundamentals are really just not there. Now, when we look at speculation, maybe from a more quantitative perspective, there are measures of it. Now, Goldman Sachs has what they call it the speculative trading indicator. So this essentially measures the level of speculation. We won't get into the details of how it works. That's not really important. What's important is that it measures how speculative the market is with respect to investors gravitating more to high risk, lower quality, unprofitable speculative companies. So it has risen sharply in recent months and approaching levels of previous peaks. So Goldman has said recently that the STI has climbed to its highest level on record with the exclusion of the dot-com bubble and the COVID era mania in 2020, 2021. Now, I actually didn't note down exactly when they started recording this, but it goes at least as far back as the dot-com bubble. So quarter century at least, and likely a little bit longer. So that's a concern. And that's a concern in terms of the mindset of how investors are thinking right now. It's a concern really also when you look at it from the perspective of where we are in the economy, like the global economy. So there's a lot of uncertainty. There's a lot of things going on that are highly unusual in terms of trade wars, tariffs, reconfiguration of global alliances and supply chains, increases in wars, a lot of things, right? Global economic uncertainty. So this is generally not the time that you would expect investors to take a higher risk approach, but it does seem that that is what investors are indeed doing right now. So the question is, are we now approaching another one of these points in the market, like the dot-com bust and the meme stock mania, where we are going to see a big decline? Now, with the meme stock mania, that also included the technology industry. A lot of technology companies, particularly those that serviced the pandemic situation, like Zoom, a few others, they had tremendous performance going out of the pandemic, through the pandemic, out of the pandemic, and then they hit that wall. Many of these companies, well, the Microsofts, the Alphabets, many of those have recovered, and then some. A lot of those companies have not, and in many cases suffered declines in 90% or more. And these are companies that were considered to be solid leaders in their industry. So while the meme stock mania didn't cause a major market meltdown like we saw in the dot-com bust, in certain industries, in certain areas, it caused major downturns, significant downturns. And for some of those areas and some of those companies, they never recovered. So the question is right now, what is happening? We do have high valuations in the market, as Ryan has reported on in the past in different segments. But we also have high levels of uncertainty. Now, what I think is happening largely is just the excitement around some of the technology trends like AI that's driving this. A lot of the excitement, again, around Bitcoin. People see other people making quick money, and that's really what fuels the desire to be more speculative, right? If you hear of stories of somebody making millions investing in Bitcoin or a meme stock or some speculative AI company, human nature is that you want in. And I think that is really a lot of what is driving this right now. Now, emotional bias, obviously, there's the fear of missing out. As I said, you see other people making money. You want a piece of that. But really, it's when you're looking at investing, you're looking at the two different types. One being real investing, using fundamentals as an example, where you're actually looking at a business, you're analyzing the cash flows, you're analyzing the valuation relative to the underlying earnings, all the aspects of the business. That takes logic. That takes planning. It takes effort. It takes expertise. Whereas when you're looking at these narrative-driven stories, it's all about emotion. It's all about creating a story whereby somebody believes that they can get something amazing and transformational, essentially given to them, right? And that's always an easier sell, at least for people that want to that are really looking for that kind of thing. So it doesn't mean that you can't speculate on some interesting securities, but you also have to remember speculation is not investing, right? So you would do that with a smaller amount of your portfolio, akin to going to Las Vegas and gambling. You wouldn't mortgage your house, or at least I would hope not, or invest your entire investment portfolio on the blackjack table, hoping that you're going to win big money and then be able to retire that way. No, everything should be done proportionally. If you want to speculate, but understand that that's not real investing. So as the investor mindset changes, if it doesn't stop, if investors continue to gravitate more to speculative, higher risk investments or securities, speculations rather, what essentially happens is you enter a period of overvaluation. You have more and more lower quality assets or lower quality promotional teams entering the market to raise money from investors. Decent assets are still coveted, so they will trade it at very high valuations, higher valuations, but just assets across the board, stocks across the board will be more expensive. Things that are worth very little will trade for high valuations, and eventually everything explodes. And this is where you have a market meltdown. So are we there yet? I don't think that we're there yet. Economically, certainly there are concerns. I don't think that the valuation is quite at the point where what we're certainly not what we were seeing in the .com era, but certainly concerning given that all of this speculative hype is coming back into the market, but there really is not a good economic reason to support it, except for the advancements we've seen in AI. So ultimately, long term, the fundamentals matter. As I'd said before, it doesn't mean that you can't invest in some speculation or put money in some speculations in the hope for great gains. But investing is not about just hoping for great gains. It's about understanding the asset you're buying, understanding the risks and the opportunities associated with it, and making sure that there's a good balance. You're not overly risking your capital to chase returns. When you're looking at speculations like invest or like putting your money in companies that aren't producing any revenues or earnings, really it's a very feasible downside scenario where you're losing 100% quite easily. And the upside, although attractive nominally, the likelihood of achieving it is actually very low. So it's really more speculation is more about hope. Investing is more about analysis and making a calculated decision. So balance is key, but ultimately never speculate with what you cannot easily afford to lose 100% of. So that's all that I have. For anybody who wants to point out that there is a spelling error in my image, speculation has 2 C's. Yes, I know. But this image was created with AI, and I told it 3 or 4 times to correct that, and it just couldn't do it. So I give up.
I think, it's a good image. But honestly, like if there's quality in there's quality and what we would call not quality, even at the mega caps at the top. There's quality in large caps and not quality. There's quality in mid caps and not quality. There's quality in small caps and not quality. If any area you're going down risk and going to non-quality, you're going to get into trouble. And if people are doing that with non-profitable companies, and we see this all the time in certain cycles, then it's something to be wary with. You shouldn't be doing it in a down or up cycle. It is pure speculation, a company that doesn't have any profitability behind it. So it is high level of speculation. And you just the webinars that were coming up, at the end of this week, one of the main things we talk about is the data-driven analysis of why we look at profitable small caps. It's because, when you look at the data, not just looking at our past recommendations or anything, it's, 90% of the companies that went up 10x, so did 1,000% over about the last decade, started profitable. So you can think that, yes, I'm going to miss out on a business growth if I don't get in before it hits revenues, or I don't get in before it hits profitability. It's just incorrect data-wise. If you look at the numbers, you give yourself a fighting chance. The stock market is hard regardless. Give yourself a fighting chance to at least be in the circle, the area of where you find these stocks that actually do that profile. And no, it's not unprofitable businesses. It's 1 out of 10 in that select area that you're going to bet on the 90%, and those are profitable businesses. So it really, when you look at the data, it shouldn't be some area where you think you're going to make money. Unprofitable stocks is what I'm talking about. Don't look at those companies. Wait till they're profitable, and then you actually have that chance of finding a stock that actually can power your portfolio. And that's what everybody's looking for. So we keep harping on that. You can get these silly seasons that Aaron's talking about that could be coming right now, where maybe you'll make a little money. Most people will get their capital destroyed if you follow into silly season and buy unprofitable businesses. Soapbox.
One thing that I'd like to say too is just relating to the image that Aaron showed on the screen there, like the speculation wave, and then the reality rocks. Even if we just related that to AEHR Test Systems that I'm looking at, again, they made this acquisition. They're doing more burn-in testing for these higher performance AI semiconductor manufacturers, which is great. They've announced this contract today. Speculation has taken the stock up significantly. And really the question is how do those rocks look? The reality rocks. How are those fundamentals in Q1 and Q2 going to look? Maybe they're going to be tremendous and the stock will, continue to just rifle higher. It could. But again, that's just the unknown. And I would say again, like with a company like that, it's got AI around it. There's certainly speculation that is driving this move today, thinking that, wow, orders and backlog is going to be, just booming. Meanwhile, management is still hesitant to, reinstate their guidance given, potential delays and pushbacks. I just kind of wanted to make that comparison. And then as well, I've beat the nail on the head so many times on the podcast, but Tesla, I've been talking about Tesla's gross margins declining. Meanwhile, the stock just continues to tear higher. And again, like they're profitable. Like I don't think Tesla is this horrible business, but there's no doubt that speculation has just continued to make sure that it's trading at sky high valuations.
Which, interesting enough, with Tesla, it was really probably one of the first like major meme stock rallies from 2019 to 2021. You just saw the retail community take it from not just a car company, it's that AI automation, autonomous vehicles were meant to be in 2017. I don't know what year it is, but we don't seem to have autonomous vehicles at this time. And the stock, it's not even performing well as a car company as far as the fundamentals go at this point in time. You're seeing declining revenues, not even growing revenues anymore, which you could make that case in 2019 through, I think, like 2023 or 4. They did at least have growing revenues. They had growing a trend through from a loss to profitability. You just don't have that anymore. So your entire speculative upside is they're going to have that dancing robot or whatever it happens to be Musk wants to put out on the showcase that year or until that falls apart because it meets reality and it doesn't work anymore. And as far as the share price tearing, it's actually still below the 2021 high, just so people are aware. It's done great the last couple years or so. But if you look even back to 2021 when there was that big speculative bubble, it's still lower, $30 lower, but it's still lower.
Yeah, for sure. And I was talking about the quality in the mega caps versus the lower quality based on earnings. I mean, you can kind of see what we're talking about there. But and Aaron was talking about people going really down market and talking about, you're talking about a quality small cap versus a company that doesn't even have revenues, right? So, I mean, really, and then if people are entering those en masse now, the markets will have a problem at some point because those companies do not deliver. And that is where you can lose a heck of a lot of money. And we would steer our clients, anybody listening this, to not play in that segment unless you want to lose your money. Go to Vegas, put your money on black or red. You'll have a little more fun, and you probably have better odds of making money. All right. I think that's going to end off our show for this week. Again, those webinars, August 28th, September 2nd, is it, Brennan? Yes, and there's one on the 30th as well, isn't there? If you want to become a full client, the full VIP, you can find that on www.keystocks.com. And as always, first I'll say, if you're watching this, smash that subscribe button on YouTube. And if you are listening to this, wherever you consume your podcast, rate and review us. Keep your questions coming into our Your Stock Our Take segment. We'll endeavor to answer those on a weekly basis. And as always, I wish you profitable investing. Thank you.
Thank you.
Thanks, everyone.
Thank you.